Hello everybody, today I'm going to compare a return of premium policy versus a whole life policy. What is a return of premium policy? It's actually a new type of term insurance policy where if you do not die within the specified term, you would get all your premiums paid back. Unlike most term policies, you get nothing back. So sounds like a good deal. Maybe it is, maybe it isn't. But we're going to compare getting something like that versus a whole life. So in this example I have here, I'm using a 30-year-old male, okay? And the premium payment in this example, let's put ROP here, is $35 a month, okay? So in this example, they're paying $35 a month, and the yearly premium comes out to $420 per year. So very inexpensive, right? Term policies are inexpensive. You get the maximum amount of cash value for the least amount of money, right? And the total premium payment, as we're saying, is for 30 years. Okay? I'm going to pay premium for 30 years because this is a 30-year term. You can get term in 10 years, 20 years, 30 years. In some cases, some companies even offer 5 years and 15 years and 25 years. But the normal on a regular basis is 10 years, 20 years, or 30 years. So we're using 30 years here. So $35 a month, and for the total year, it's $420 per year. So the total payment over a 30-year period is going to be $12,600. So in essence, you're going to get back your $12,600 should you not die after 30 years. The death benefit here is $500,000. All right? So nice death benefit for what you're paying. Let's look at the whole life. Okay? So whole life comparison, same amount of premium, it comes out to 30, minimum amount of premium here comes out to $36.33, only like $1 and some change more. So $36.33 per month. Okay? Total year, $436. So pretty much in the same bracket, right? $436. And we decide that we're going to pay premium for 30 years here because even though it's a whole life, you don't necessarily have to pay premium for your entire life. Okay, you can stop paying premium at a certain point. Okay, so 30 years we're going to pay premium. So in the full 30 years, let's put that here. In the full 30 years, total payment is $13,065. That's what we're paying for 30 years. And our death benefit we will receive is $39,666. So huge difference, right? Huge difference in death benefit. Again, with term, you're getting the maximum amount of death benefit, the least amount of money. So you're spending pretty much the same money every year. But look, because it's a whole life policy, you're getting a lot less in death benefit, right? But the difference is, after 30 years, the policy ends over here. This policy continues for the rest of your life. So you're going to have that policy regardless. So that's the positive over here with the amount of death benefit, right? But then the negative is it ends after the year is up. And then over here, the positive is that it continues regardless. Okay, it's going to be there for the rest of your life. However, you get a lot less in death benefit for the same amount of premium. Okay, now since we don't want to pay no more premium and it's a whole life, we'll execute what's called a reduced paid up, RPU in year 31, which comes out to 33,795. Okay, so a reduced paid up. In reduced paid up, we're taking the cash value that we have in the policy and we're using it to buy a reduced death benefit. So it's going to be less. So the cash value that they have at this point was able to buy $33,795, right? So let's say you continue to live. In year 40, that's going to go back up to 38,523. Okay, if you continue to live to the year 50, you're at that point that will be 80 years old. It will be 347. So with a whole life, the death benefit will continue to grow as long as you stay alive. You're not, even after you're done paying, right? So it works like that because of the cash value aspect. And as the cash value grows, the death benefit has to grow as well, so that the insurance company have to have some type of risk, right? So long after you're done paying, it's going to continue to grow. So that's another positive there. So that's what you have right over there. Now, having said and saying all that, which one would you pick? Which one is best for you? Well, it all matters, right? If I was to ask you who wants to die at age 65, who would rather live past age 65, I would bet most people do, right? Probably nobody would raise their hand if they want to die before 65, right? So most people would want to live longer. So if you want to live longer, you probably want to go with something that's permanent. So the answer to the question, which one would you pick? I would say for you, you should decide which one is more likely to happen in your situation. So if you think that you're going to die before 65, then that might be something you'd rather go and say, you know, I think I'm going to die. My family will get 500,000. If you think it's less likely to happen, and you can only afford one or the other, if your finances could only afford one or the other, and you have to choose, and you think this is going to happen, then you choose this. Now, if you think that this is more likely, you're more likely to live past 65, then, and your finance could only choose one of this, then you do that. Here's what I would say: if you can financially afford both, why not get both, right? Because then you have more back in here. You got a lot more death benefit here, right? If that did happen, if you did die before 65, plus you're still getting this over here. But if that didn't happen, at least you know you have this to fall back on, and you have something that's guaranteed to happen, and you have a guaranteed death benefit here. So hopefully that was helpful for you guys. Hopefully it makes sense. If you have any questions, please leave it in the comment section. And also, if you haven't already done so, make sure you subscribe to the channel, like the video if you find it informative, and share it with someone that could also benefit from the information. Until next time, talk to you soon.